Hello everyone, and welcome to this presentation of Catching Big Trends with Bollinger Bands. Now I know that Bollinger Bands are a very common way, a tool in which you can trade with, a way in which people trade with many tools, and one of them, as we stated here, is Bollinger Bands. But in today's presentation, I'm going to give you all the complete rules to a strategy that incorporates the Bollinger Bands in a unique setting and a unique style. For example, if we take the first chart here of Tesla, I'm going to show you all the rules. So just with the amount of bars shown here in this chart, you would have been able to capture and identify a very nice buy setup right here, and hopefully been able to capture this many points in Tesla. So I'm going to be giving you all the rules, all the ways in which to enter, place your stop, and also to exit with this particular strategy. So welcome once again. My name is Steven Primo. I am the president and founder of Specialist Trading, and as I see here, I have one more example to show you as well in CVS. Forgot to mention this one as well because I know a lot of people not only go long stocks, but they also will short as well. The same rules would have given you an entry point right here, just based off the amount of bars, and hopefully once again would have been able to capture this really nice, strong, trending downward move. So if I start over again, thanks for joining us. My name is Steven Primo, president and founder of Specialist Trading. If you're new to my webinars, we are all about educating you. We are first and foremost an educational company. I know we're different from a lot of other websites in that they give you systems and tell you exactly where to enter and where to exit. But our foundation is just built on supplying you with education so that you can put all of the power back in your own hands so that you can make your own trading decisions. It's been my experience in my 40 years of trading that the reason why most traders fail is because you're relying on someone or something else to tell you how to trade. But what we do at Specialist Trading is give you all the things that have shown consistency in the past and then put together a plan with you so that you can ultimately be making your own trading decisions. Now, I know this because I've been trading for 40 years. As I stated, I started my career on the floor of the Pacific Stock Exchange. I was on the floor for a total of 16 years, and 9 of those years I was a specialist, and a specialist simply made markets in roughly about 50 stocks. So if you wanted to buy or sell a particular equity, you had to go to the trader who specialized in those and made markets in those stocks. I traded as a specialist through the crash of 1987. I was on the floor, and then the bull market that followed. And I left the floor in the mid-90s to manage money and to pursue my own trading. And around 8 years ago, I teamed up with Pro Trader Strategies, and we put together Specialist Trading, where all we do is educate our members and students around the world in over 110 countries around the world, and in virtually every state in the United States, people are trading our methods and techniques so that we can put education back in your hands and you can make your own trading decisions. So that's what we do at Specialist Trading. And as you can see, we're going to give you a lot of attention to detail and just how much we like to educate you in today's presentation. As I stated, I'm going to give you all the rules to a really great strategy that applies the Bollinger Bands. But before we begin, as always, we are required to show you this. So please take a second to view our disclaimer. I'm going to show you a lot of performance results using this particular strategy, but please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. Once again, we're required to show you this. So as you're taking a brief moment to view our disclaimer, I would also like to invite each and every one of you, if you haven't done so already, to follow us on Twitter. So you can catch us on Twitter as well. Our handle is at SPCLSTTRADG. Okay? Now, as I stated, we are first and foremost an educational company. You know, we're all about educating you because we really want you to make your own trading decisions. So as you see here, my goal is not simply to force feed you signals, to tell you on a nightly basis, here's what you should buy, here's what you should sell. Now we have strategies that come with all the rules. We also have a signal service, but that's for educational purposes only, kind of a way so you can check your work so that you know what to look for. But ultimately, we don't want you to turn those things into crutches the way so many websites do. We just want to give you the information so that you'll know what to study, you'll know what to look for on a nightly basis, and ultimately you'll be able to go out on your own. This is the way I was taught some 40 years ago, and hopefully you'll be able to sustain your trading for the next 40 years. Okay, so here's what you're going to learn today. Now, one last thing I'd like to say, I'm sorry, before we begin. I know this is going to be conducted like a class, but since it is a class, you are free to ask questions, but kindly wait till the very end of the presentation. I have a lot of slides to show you, and if we stop every couple of minutes for a question, this presentation will last about 5 hours. So let's wait for about another 35 minutes, and then we'll take the last 15-20 minutes for any questions you may have, okay? The only question I will answer is the most common and most popular one, and that is this being recorded? And yes, it is. We record all of our presentations. So if you're having technical difficulties, or if you have to leave early, just contact Pro Trader Strategies, and they will send you a link to this recording. All right? All right, so kindly wait till the end to ask any questions. And let's start. Here's what you're going to be learning today. We're going to give you a brief refresher course about the common uses of the Bollinger Bands, okay, the way most people apply them to their trading. And they're a great, great tool. But we're going to also share with you a proprietary setting that we have for them that come in link with this strategy we're going to be sharing with you. Strategy we're going to be talking about and giving you the complete rules to is strategy 3A. Okay, so that's basically what we're going to be talking about in today's presentation. All right, so let's review. For those of you who aren't really familiar with Bollinger Bands or didn't really apply them in the past, let's just review exactly what Bollinger Bands are, and let's give you the standard definition. Okay, Bollinger Bands consists of a center line, and that's just simply a moving average. And then two price channels. These are the trading bands, and one is above the middle moving average and one is below it. Okay, these make up your three Bollinger Bands. Now, when the market becomes more volatile, the bands widen, or they get further apart, all right? And they move further apart from the middle moving average. And then during less volatile periods, when there's not a lot of movement, the bands contract, or they move closer to that median average, all right? Now, the tightening of the bands, when they come close together, is often used by technical traders as an early indication that the volatility is about to increase sharply. So that's the common use and the traditional way in which Bollinger Bands are applied. So if we look at this generic chart here, we see that this is the settings for the Bollinger Bands, and when the top one is headed lower and the bottom one is headed higher towards that moving average, you have this kind of little movement or tightening of the bands. Then we have volatility to the upside, okay? Now, conversely, when they're contracting to the downside, the top one, and then the bottom one is contracting upwards, and you have this tightness coming in space, then you have a downward move in the volatility, or a very quickening move. Here's the only point, though. We don't know which direction we're going to be headed, all right? We really don't have any idea. At specialist trading, we like things that are cut and dry. In other words, when two traders look at the same chart, they're going to come up with the same analysis. Everyone's going to, off of the things that we teach them that have stood the test of time for 40 years, you're going to come up with the same analysis. So there's no difference in one person looking at the chart as another. But whereas if you look at this, it's a little bit too subjective. Someone could say, well, they've come down far enough and they've contracted, so I see a really big move to the upside, where someone would say, no, they're going to continue to go even lower. So how do we make things more black and white, easier to figure out what exactly is going to be possibly taking place in the market? Well, this brings us to strategy 3A. This is the one I'm going to be teaching you today. Now, here are the highlights of this particular strategy. It's a continuation strategy. If you're not familiar with what that is, it means we're looking for some idea of a small trend that's starting, but then it stops, it pauses. All right? On that pause, it's going to give us all the requirements for entry, and then once it takes off, that's where we're jumping on board the continuation of the trend. Okay? Now, it uses a unique Bollinger Band setting, which I'm going to be giving you in just a few minutes. It's designed to trade quick, powerful trends. So you can apply this virtually to any market, any time frame, in any direction. And also, it doesn't matter what you're trading. So in other words, some people like to actually purchase the stock, others will purchase options, others like to trade futures, others trade commodities, currency pairs, makes no difference, okay? But as we always caution all of our members and students with any strategy, please paper trade first. There is so much to learn from this simple process of paper trading. Many people have seen this strategy before, and the minute they understand it, their eyes light up and they go, this is just too good to be true, this is too easy. And then the second they start trading it with real capital, they lose money. It's not because there isn't some consistency in strategy 3A, it's because you're implementing it incorrectly. In other words, you haven't studied it enough. So that's why we always say paper trade first, so that you fully understand the process. And then when you fully understand it, you've got it under your belt, then apply real funds. I'm not going to sit here and tell you that every trade is a winner, okay? But that's okay. Our edge at specialist trading is consistency. In other words, we're looking for a two-step forward, one-step back approach. We know that not every trade can win. We know that we will have small losses from time to time. Just the same way every athlete loses every once in a while. Every entertainer has a flop movie or doesn't have a hit record every time. It's the same way with trading. Not every trade is going to be a winner or a profitable one. That's all right. As long as you have some consistency in your method where you're able to hopefully very soon recoup what you lost, well then you have the makings of a very consistent strategy, and that's what we have at Specialist Trading. So remember, paper trade and learn everything, all the rules and all the process behind this particular strategy. Okay, let's get into the settings now. Now, these are the standard Bollinger Band settings. So whatever charting software program you're using, if you are able to open up the settings for the Bollinger Band, you'll see that they're usually defaulted at 20 for the moving average. That's the middle Bollinger Band, okay? That's set at 20. And then the upper band and the lower band deviation, and don't ask me to go into the definition of these, you know, it's too complicated, and plus it really doesn't matter. But that just basically is talking about the distance from the moving average, how far away the upper band is deviated from the middle moving average and how far the lower band is deviated. Those are usually set at the same, but just +2 for the top one and -2 for the bottom. That's the distance, the equidistance they'll be from the middle moving average, okay? Now that's just your standard. So when you open up a standard Bollinger Band setting, you'll see that. Here's what we want to do. We want to change and alter things. Now, if you look at the standard settings, this is what it usually looks like. We want to change it a little bit to read this. We're going to leave the moving average alone at 20. So don't change anything there, okay? We're only going to change the upper and the lower deviations. Instead of reading 2, +2 and -2, we're going to go down to a fraction. So the upper band deviation will be +0.382, and the lower band deviation will be -0.382. Now, every time I've given this webinar, this is the most common question that I'm asked. Can you give those settings again? So if you have a pencil and paper, it would be good to write these down. Even though I'll repeat them, don't worry. It would be good to write them down, because I also get emails saying like, I saw your webinar and I forgot what those settings were. So remember, the moving average, which is the middle band, stays at 20. We're going to keep that. That's just a simple moving average, a 20-period moving average. The upper band is going down to a fraction. That's +0.382, and the lower band goes down to a negative fraction, -0.382, okay? Now, let's look at the standard setting, what I showed you just a few minutes ago. This is the standard setting when you apply the Bollinger Band. As you see the contraction taking place there, here's the way they look once you change the settings. Okay, do you see how we have that much smoother approach? It's the exact same chart, but we've just changed the setting. This smooth approach, without that contraction, is going to help us with strategy number 3A. It's going to determine where we enter and where we exit. It's going to really help us determine if a valid trend is underway, okay? All right, so let's go over the rules step by step. And don't worry if you don't get it right away. Remember, this is being recorded, so you can always access the recording and watch it over and over again. And plus, I'm going to show you a lot of slides where it should sink in rather easily, okay? Okay, step 1. What we want to see are 5 consecutive price bars. Oh, by the way, these are steps for going long. We're going to reverse the order if we go short, obviously. But step 1 says that we want to see 5 consecutive price bars close either on or above the highest Bollinger Band. Okay, so we've already altered the settings of the Bollinger Bands. We've placed them on our chart, whatever it is. Could be a monthly chart, could be a weekly chart, a daily chart, could be currency pairs, commodities, stocks. It makes no difference. Whatever chart we're looking at, we have the setting for the Bollinger Band on there now, and we want to see 5 consecutive price bars either close on or above that highest Bollinger Band. So let's just, for educational purposes, look at a 5-minute chart of the E-mini, because it really just explains it very easily. Here's the Bollinger Bands. And as you can see, we have 1, 2, 3, 4, 5 Bollinger Bands setting here, but actually it didn't really, the next one closed below. We didn't really break out, and then we have closings below and then back up. But here, what do we have? 1, 2, 3, 4, 5 closes above, okay? So these are all valid closes above. And in an ideal scenario, we want to see the bars remain above. You know, it's okay if they touch, But as you can see here, they touched and then they went below, so it's not a really valid signal or setup. We want to see if we can have all of the Bollinger Bands not touching the top, all of the price bars not touching the top Bollinger Band. Now, if they do touch it, at least you want to see the closes still above, okay? So we have 1, 2, 3, 4, 5 closes above. Let's go to step 2. Now we're going to look for a short-term pivot high to be created above the highest Bollinger Band. All right, if you're not familiar with what a pivot high is, it's simply a 3-bar pattern where you have a high followed by a higher high followed by a lower high. So let's look at that, see what that looks like. As you see here, bar number 1 creates a high, bar number 2 is a higher high, and bar number 3 is a lower high. So you create this kind of arrowhead approach here, okay? Now you're going to see short-term pivot highs when the market is going higher. So here we have the 5 bars, and the short-term pivot high can actually be within that 5-bar setting, or it can be anywhere afterwards. But as you see right here, it's within that 5 bars. A high, followed by a higher high, followed by a lower high. See how that works? All right, step number 3 now. We're going to enter to buy when price trades 1 tick above that short-term high. So let's look at the short-term high here, okay? Now, we want to buy right here when price trades 1 tick. And once again, preferably, we would love to see none of these price bars touch or go below the top Bollinger Band. It's okay if they do, but if a price bar closes below the top Bollinger Band before it reaches its buy setup area right here, the trade is negated. We're going to have to look for another setup. We're going to look for another countdown, okay? Because remember, this is designed to capture quick momentum trends, okay? So that's what we're looking for. If price is above this highest Bollinger Band, that's telling us most likely we're going to go higher. But if it closes below the highest one, then it's telling us that the trend may be, dissipating or losing energy. So we don't want to be in it then. We'll have to wait for another countdown, either in the same chart we're looking at or in another market. So let's track this. As we can see, price bars are staying above the highest Bollinger Band, and we continue to go higher. And as we go higher, we wait for it to trade here at this point. That's our entry point. It does not have to close above that short-term pivot high. It just has to trade there. All right, so as you can see, it traded there, and we entered long. Now, it did not close there. In fact, it closed below our entry, but that's okay. All right, so you see how that all works. That's our entry point. Now, step 4, we're going to sell or exit on a range extension of 200 and or 300%. All right, so what does this mean, a 200 and or 300% range extension? It's very simple. I know it may seem complicated if you've never heard of a range extension, but remember when we identified the top of that short-term high right here, okay? Here's where it was. Well, that's the top of the range. That's where the rally ended, and we're buying 1 tick above that rally, all right? Now, where did the rally begin? The rally began back here. So this is our range from here to here. And so you simply bracket that off, you measure the amount of points that is, and that equals 100% of the range from where the rally first started to where it ended, and then we're going to be buying 1 tick above. That equals 100%. So however amount of points that is, that's your 100% range, and to exit at the first exit point, you would simply double that, and that will give you 200%, and that could be your first exit. And if you wanted to go for more points, you could exit at 300. You would take that same amount of points and add it again. And had you done this on this 5-minute chart, that would have resulted in just about 3 hours, a 17-point gain in the EMini, roughly about $850 per contract. So you see how simple this is. Now, a lot of you are saying, well, how about stop placements? How do we protect ourselves? Well, our standard basic stop is basically about 50% of that range extension. So if you know you're going to be entering here, and here's where the rally started, and this is the amount of points in your range, you're basically going to put your stop just about at the 50% level, all right? So if you exit at the 200%, you're basically having a 2-to-1 risk-reward ratio, and so on as you go higher. Now, a lot of our traders who trade this method like to use a different way to trade it. What they'll do is Once they see that they get up to 200% range, they won't sell. They'll move their stop to unchanged. So that if the trend dissipates and stocks or E-mini falls out of bed, at least you'll break even. Some will say, okay, well, I'll move my stop to 200 and then I'll exit everything at 300 once we get up closer to here. Still others will say, well, I'll sell part of my position here and then a part of my position here. All right. So there's a million and one ways to apply this to your trading. As we stated, our goal is not to tell you how to trade it. Our goal is not to say you must enter always at this price and you must always exit here. You must place your stop. Feel free to experiment with it. As long as you're keeping in line with this same basic method, that's okay. We want you to become a part of the process. As I stated, in my 40 years of trading, the only way I've seen traders become successful in terms of being consistent is when they are a part of the process. In other words, when they are making their own trading decisions, not when they're going to a website to find out what to do. All right, that would be similar to a brain surgeon in the middle of surgery asking, his assistants, "What do I do now? Okay, where should I operate?" Well, it's the same way with trading, though. This is the way 99.9% of traders trade. They're always asking someone, "What do you think of the market?" Or they're watching TV to find out what some pundit thinks of the market or a certain issue. Or they're going to a chat room or a trade room. We think that most traders will turn those things into crutches and ultimately, by doing that, take themselves out of the game. What we're trying to do at Specialist Trading is give you all of the tips and techniques and methods that have stood the test of time, work with you, and then put you back in the game by helping you to make your own trading decisions, okay? All right, so that's the basic strategy in a nutshell. Let's look at a lot more strategy 3A examples so that you can really understand the process much, much better in different markets. In fact, let's start out with stocks for all you stock traders, okay? Remember we started out the presentation looking at that chart in Tesla, and I said, with this particular strategy I'm going to be teaching you today, you could have been able to been in this trade here and hopefully have captured all these moves to the upside. Well, how could we have done it? Obviously looking in hindsight, someone would say, well, Steve, it's easy to see. I would have liked to have gone long down at the bottom there, but how could I have done it? Well, the first thing we do is apply the proprietary Bollinger Band setting. Now, just to backtrack on the Bollinger Band setting, remember, if you're having difficulty with figuring out how to do that, you've written down the setting numbers, just contact your tech support at whatever charting software you use. They should be able to help you set it up, okay? Okay, so what do we want to do? We want to see, since we want to go long, we want to first find 5 bars that close above the highest Bollinger Band. Now, here we have, let's see, 1, 2, 3, but then we close below. Okay, we have 1, 2 below to go short, but then we close back above. So we don't have any settings here. So it's okay because it's keeping us out of getting into the market until right here. We start to have consistent closes above. In fact, right here we have 5 closes above. So that's step number 1. Requirement number 1 is met. Now we're looking for a short-term pivot high, a little top that's been created. It can either be within that first 5 or anywhere afterwards. Okay, that's going to be our point of entry. But we have to find that first. And here it is. Okay, it's created a little later. Here's the high, followed by a higher high, and then a lower high. So we create that arrowhead approach. So this tells us that we're going to be going long if we stay above the highest Bollinger Band and we trade here. And as you can see, a few bars later, we did. So we entered at 203.01. Now remember, we know that Tesla is an expensive stock and not everyone can afford to purchase a stock of this price. But you could have easily said, well, the minute it trades at 203.01, I buy long calls or some type of option strategy. It makes no difference how you decide to enter. You don't have to purchase the stock if you don't want to. All right, so that's our entry. Now we have to figure out the range extension, okay? Now, here's where we had the short-term pivot high right there, and here's where the rally started, down here, okay? That equals 100%, as you can see right there, okay? So this equals 100% range. However amount of points that is, we just added up from the top of that short-term pivot high to where the bottom was, where the rally started, and then we double that amount of points to give us our 200% exit point, which would have been 23 points higher. Now, if you wanted to, you could have exited there, or if you thought there was much more room to take place to the upside, you simply add the same amount of points to the upside, and this will give you the 300% range extension at 249. So now you've got a 46-point gain. Now, here's what we tell our students. We always say when you're first learning this strategy to exit either at 200 or 300, preferably at 200 when you're just beginning. But once you get a little bit under your belt, you can extend it to 400, as we see here. And all you would do would be the same process of just adding the same amount of points, and this one would have been your exit at 272 for a total gain of nearly 69 points in just a little over a month. Okay, actually, I think less than a month. But we always caution our students that if you're going to go up to the 400% range extension, that's where you should be out of your position completely, whether it's options, whether it's the actual stock, whatever you're trading, because we've noticed this is not a steadfast rule. We don't systematize this, so there's no statistics. Remember, we teach strategies that have discretion for you to apply. But we've just noticed over time that at the 400% level, that's usually where the trend changes. So you don't want to give back a lot of your profit if it happens to turn around completely. So what you'd like to do is exit everything. But how you decide to trade it, if you want to exit everything here, or exit part of your position here, part here, or move it up all the way until you finally get out of 400, it's entirely up to you. Once again, your stop would have been down here, roughly would have been at 50%, and that would have been about a 12-point risk parameters. Now, if that's too much, well, guess what? Don't take the trade. You know in advance, I can't risk 12 points with the amount I have, so you know that that's not a trade you can take, but that's okay. All this information is given to you before you even initiate the trade. Okay, how about CVS? Okay, well, here we have 1, 2, 3, 4, 5, 6 closes above, and we never created a short-term high because the next bar closed below, so there's no setup to go long. But what do we have now? We just simply switch direction. We have 1, 2, 3, 4, 5 closes below. All right, so this is setting up for a short trade. We knew this well before we fell out of bed down here. Okay, did we know this because of any news happening? Absolutely not. We don't follow news. We don't suggest or require any of our students to look at all at news. News is something that's extremely important if you're an investor, if you're holding things for 5, 10 years. If you're trading, holding on to things for weeks, months, there's absolutely no reason to look at news. Trust me, take it for someone who's been trading for 40 years. I stopped looking at the news 40 years ago. So if I'm still here, there's no reason why you can't by not looking at the news. So the market was telling us everything we needed to know. It closed 5 bars below. It created a short-term pivot low. That's just the opposite. We have a low followed by a lower low, then a higher low. So now it's the opposite of the high. It creates this type of a V approach. So this tells us that as long as we stay below this low Bollinger Band, we're going to be going short. And we did. We stayed below, and right, the first tick below it, you could have gotten short at 92.24. Remember, once again, you could have purchased puts. It makes no difference if you actually have to trade the stock just because you're going off a stock chart. Now here's where the short-term pivot low was right there. So that's the bottom of the range. The top of the range was where the rally started. So you just measure that amount of points, and to generate your exit points, you would subtract, and there would be your first exit, roughly about 6 points lower. Here would be your second exit at the 300%. And here you would have lucked out because you would have placed an order, most likely a limit, to buy at 79.87, and you would have had a very nice gain right here because we gapped down much lower, and you could have actually covered your position at the low of that day at 69.70, about a 10-point plus gain. So altogether, you had 22 plus points to work with in this particular trade in just about a month and a half. Okay. Let's look at SCG. Once again, in hindsight, someone would say, well, sure, I would have loved to know to go short, but how could I have known in advance? It's simple. The reason why we don't know in advance is because we're listening to the wrong things. We're listening to the guys in chat rooms or on TV. My mentors taught me, because I was doing the same thing and not seeing positive results, they said, Steve, just listen to the market. The market will usually tell you just about 3/4 of the time what it wants to do in advance. The only trouble is we've never been trained to listen to the market. We're always trained to look at what the institutions are doing, what some convoluted indicator is doing, volume. Keep your trading simple and listen to the market, and you'll get onto that road of consistency. Now, as we can see here, we apply the Bollinger Band setting, and we're setting up for a nice buy here, but then we never traded above, and we started closing below the top Bollinger Band. So this negates a buy setup. But now what do we have here? Now we're switching gears. So now we look to go short. This is what traders do. If there's no buy setups and then a positive sell setup generates, well, then you go short now. All right, so it's 1, 2, 3, 4, 5 closes below, as you see. And even though we bounced back up and when you see intrabar, we went above the lowest Bollinger Band, we have no closes above that low Bollinger Band. So this is still valid. So we're going to enter if we trade right below this short-term low, which is right here. So as you can see, since we stayed below, this is all valid. And once we traded at 70.09, you're short. You measure the large room of the range from the top where the sell-off started to where your entry point was and simply subtract. And there was a quick nearly 5 points in just a couple of weeks. Now, if you placed your stop at the 50% level, you're roughly risking 200, or I should say 2.5 points to make 5 points. It's a nice risk-reward ratio. All right, so let's look at Amgen now. So this is a higher price stock. If you'd like to trade options, once again, we had a nice setup forming here to go long, but then it didn't pan out because all of a sudden we're now trading below the Bollinger Band and we never went above the short-term high. So now we just switch gears once again to go short. And we have 5 bars closing below. We created a short-term pivot low right here, and we're still below the lowest Bollinger Band. So once we trade below this short-term pivot low, we're going to enter to go short. And we did at 164.43. You could have placed your stop here. Now here's another option for stop placement just above the last short-term pivot high. It's up to you because this is a more expensive stock. But we simply measure the range the exact same way from the top to the bottom, the amount of points, and then we subtract 2 and 300. And those are your exit points right there, okay? See how simple this is. Obviously, in hindsight, someone says, well, yeah, it was easy to know that once we're down, 25, 30 points to go short. But we knew well in advance to go short because the market was telling us what it wanted to do just by using one simple variation on the Bollinger Bands. All right, let's look at the spiders. Now, this is a very current chart up to, I believe it was up to yesterday or possibly up to Friday. I'm not sure, but just in the last couple of days. Once again, the spiders, someone looking back would say, boy, I would have loved to have gone long at lower levels in November, December, but how could I have known? Who knew we were going to have this big rally in the market? Well, now that you have this strategy, you could have known going back 3 or 4 months ago. First thing you do is you add the Bollinger Bands, okay? And we have 3 closes below, then we close above, so there's no setting. Okay, we have 5 closes below, and here's our first short-term pivot low. So we're going to go short, but look what happened. We started trading above that Bollinger Band, so all bets are off. We're no longer using this setup here. And now we start trading above. In fact, we've got a total of 5 closes above. So this is setting up for us to go long. So we knew back in the second week of November that a setup was generating to go long in the spiders, which represents, it's the ETF for the S&P 500 index. So it's basically telling you that there could be a nice rally coming in the market. This was in November. Okay? And then we look for that short-term pivot high, which is right here. We have a high followed by a higher high and a lower high. So we know that all we have to do is go long once we trade 1 or 2 ticks above that. And we did at 218.32. You could have purchased options in the spider. I believe they're the most heavily traded optionable stock there is, the spiders. You could have easily bought calls or some type of long strategy, spread or something like that of that nature. But either way, that was your signal to go long. I believe it was in the second week of November. All right. And how far did it project that the spiders would go? Well, we simply measure from the top of that short-term pivot high to where the rally started down here. And that's your 100% range. So you add the amount of points, you could double it, and you know that at least you're going to be going up another 10 points in the spiders, which would represent hundreds of points in the S&P. Or if you wanted to get out at the 300% range extension, well, we're only a few points away from this because this is the exit at 238. I know we had a sell-off today, but still we're not very far at all from this 300 range extension exit. So feel free to watch this. We may be trading there very soon. Tomorrow we may never get up there, but that's why we say there are a number of ways to trade this. We would always suggest for beginners, as we stated earlier, to get out at 200. Okay, that would have been a very nice 10-point gain and just about 2-3 weeks. But if you wanted to go for 300, we would suggest exiting part of your position here and then another part once you get up here. Or if you really felt we're going to get up here 238.17, then move your stop to 200. All right, right now the S&P or spiders are roughly around this level, so keep a stop somewhere around here, or a mental stop, so that you know that if it doesn't get there, if we just barely miss it and we start to go lower, at least you'll still have a 200% range extension gain. Now, if we do get there, well, guess what? You're going to be making close to 20 points on this really simple trade. Everyone's trying to figure out through fundamental news or what's going on around the world or through elections why the market's going up. Once again, there's no reason to look at that stuff. It's only good if you're holding things for 10 or 20 years. I didn't follow the news, but we could have easily just gotten long based off this one indicator. That's it, all right? Now we can apply this to indices as well. Now we know we just looked at an ETF, but here's an older chart of the Dow Jones Industrial Average. This is going back last year or so. The same thing happened with this rally. Now we had 5 closes above. We have our short-term pivot high right here. So you could have entered. Now we're not saying you can buy the Dow Jones Industrials, but let's just say you could have used this as a market timing tool. So apply this to any index that you may be trading within, and this can be telling you what the market's going to be doing. So even though a buy setup was generated here, you wouldn't have gone long. It just would have been telling you that the market's most likely going to be going higher. How high? Well, you just do the same thing on the indices. You go from where the rally started to where your your short-term pivot high was. That's your range extension. And here's your 200% range extension exit. Now, had you looked at this to determine what the market was going to do, well, that's over 1,100 point gain in the industrial average in the next couple of months. Wouldn't you like to know in advance that the market was going to be going up 1,100, 1,200 points? Well, through this measurement, you would have, okay? Now, a lot of people say, well, Steve, I like your stuff. It makes sense. But, when news comes out, you can't protect yourself. There's no way you can protect yourself against the news. Stuff comes out of the blue, out of left field, and there's no way you could be on the wrong side and you lose everything. I'm not going to tell you that that doesn't happen. Sure, it will happen from time to time. But it's been my experience, since my mentors taught me these same things some 4 decades ago, that once you learn how to listen to the market, oftentimes you're on the right side of the news because the market knows in advance what it wants to do. All right. As you saw in a couple of those situations where the market was heading lower and then gapped down. Okay. Well, that was an advancement of that gap down news. Okay. What made it go down was the anticipation that there's going to be some news coming out, some earnings, whatever, and it's going to open after that news event much lower or much higher, depending on what the event was. Well, the market tells you that sometimes weeks, sometimes months in advance. So I'm not here to tell you that, sure, this can do 100 times better than the news, but oftentimes that's why you don't have to worry about the news, because you're on the right side. Let me show an example, something that just happened a couple of weeks ago. Yahoo Finance reported that HP's earnings show the PC market is finally starting to recover. It said the personal computer and printer maker HP Inc., Hewlett-Packard, on Thursday saw its shares spike after beating Wall Street's fiscal first quarter targets. Okay, so at least 7 Wall Street analysts raised their price targets on HP stock after the company's Q1 report late Wednesday. Okay, so they came and raised their targets for the stock after the news came out. So if we look at the chart, if you see in the far right-hand corner, that's where the earnings came out for the first quarter, and that's where all the analysts said, boy, this is a great buy. Oh, we're going to raise our levels for this thing, okay? All right. How could we have gotten into this earlier? Could the market have told us to get in much earlier? Well, let's apply our strategy. There are the Bollinger Bands. What do we have here? 5 closes above the highest Bollinger Band in the first week of February, okay? Just about 3 weeks ago. Short-term pivot high right there, okay, in the very first week within the 5 bars. Our entry would have been at 15.33. We measure the range extension from where the rally started, double and triple it. Well, we've got the stock gained 15% in just 2 weeks, and we got out right there on that news. So how did we know in advancement? Did I tell all of our members, hey, everyone, the CEO of Hewlett-Packard called me up and wants everyone to get long because at the end of the month, they're going to make an announcement about their first quarter. No, we didn't know anything about that. Remember, we don't listen to news. We only listen to the most important thing, which is the market. And the market was telling us at the end of January, early February, that most likely this stock is going to go higher. Let's look at a different market, entirely different, the EMini S&P, all right? The same exact thing on this older 60-minute chart of the EMini Futures. As we see here, we're above the highest Bollinger Band. Obviously, we've got more than 5 closes, and we create a short-term pivot high. So we're going to go long once we trade one tick above that, all right? We measure the range from top to bottom, and then we simply add that amount of points, and that came out to 33 points. So in roughly a day or two, we gained 33 points for that 200% range extension exit, and it's a little over $1,600 per contract, okay? Once again, you could have placed your stop right here, and then once we got up there, moved it unchanged, or the closer you got up, move it closer to unchanged. Very simple and very easy. But this is why we say for most beginners, especially in high volatile markets such as the futures market, in the beginning to exit at the 200% range extension, because the trend can change on a dime, as you just saw right here, okay? So we'd never want you to give up a good profit. At the very least, protect yourself. So if you're going for 300 and 400, move your stop up. So even if you didn't exit here and take a 33-point gain, you would have at least broken even once the market fell out of bed. Now, how about this 5-minute chart of the E-mini, okay? Once again, we're above, but we never created a short-term pivot high that was broken out above, so we switched the other way. Now we're going short. Obviously, we have 5 closes below. We remain below the lowest Bollinger Band, and here's our short-term pivot low right here on this 5-minute chart. So our entry point is right here at 2091. We measure the range from where the sell-off started to right where the short-term pivot low was. Guess what? On a 5-minute chart, that turned out to be 61 points you could have made by the end of the day, okay? I believe this was during the Brexit debacle here, where everyone was complaining about no one knew what was going to be going on and there was no way to make money in big markets like that. Well, right here, I'm here to tell you that there is a way to make money on very volatile markets like that. You don't need to look at the news. Now, let me show you what happened last Friday, because we have a lot of traders and a lot of new members who say, Steve, I love this technique or I love your methods, but I like to trade real small intraday tick charts. And sometimes I like just to go for the volatile moves either at the beginning of the day or the end of the day. Well, here's what happened last Friday. This is a 1-minute chart, okay? Now, in the last basically half hour of trading, we had a really nice run up to the upside in the E-mini S&P on a 1-minute time frame. How could we have taken advantage of this quick move to the upside the last half hour? Well, you apply the Bollinger Bands the exact same way, okay? We have no setups here because we're kind of going sideways at noontime, but then we have the 5 closes above. We create the short-term pivot high. We are remaining, all bars are above the highest Bollinger Band. So all we have to do is enter once we trade above, which we did. Roughly at 12:30, which is a half hour before the close, 12:30 Pacific Standard Time, you could have entered at 23.60 and a quarter. Here's where the rally started, so you measure a range. You could double it and triple it. And in a quick half hour, that's 5 points per contract, or roughly $250. Now, I know it's not a lot, but that was only done in roughly about a half an hour. And also, that's on one contract. You could have traded 10 contracts for $2,500. It's up to you. Remember, it's your decision. You could have exited at 200 if you wanted to. How about the Forex markets? We know there's a lot of traders that like to trade the currency pairs. Here's a 4-hour chart of the Australian dollar. Obviously, we're going to look to go long because we're closing above the highest Bollinger Band. Now, here was a really nice setup, but then what happened? We closed below before we broke out above that short-term high. So all bets are off. We negate the setup. That's okay. There's always a lot of setups being generated. Now we have a new one being generated. Now we have 5 closes above, and all we have to do is enter the Australian dollar once we trade above here, which we did at 76.77. Okay, here's where the short-term rally started. We could have entered here, and that's a quick 67 pips in the next couple of days, or $670 per contract. Okay, that's trading short-term. Let's look at a daily chart of the Canadian dollar. Obviously, we're going to be going short because we have more than 5 closes below, and we created a short-term pivot low. So our entry is at 39.05. We measure the range extension where the short-term pivot low was and where the sell-off started, and 200 and 300 range extension in the next 2 or 3 months, okay? 1,500 pips, roughly about $15,000 per contract that you purchase. So as you see here, nothing changes because we change time frames, because we switch markets. Nothing at all matters. It doesn't matter if you're trading in a 1-minute chart or a daily bar chart. So let's recap before we go to question and answer, okay? This is a continuation strategy. Remember, we're looking for the Bollinger Band setting to give us an idea that a trend is starting by closing above or below. And then we're looking for it to stop with that short-term pivot high or short-term pivot low. And we know we're going to enter once we trade above it. If it never trades above, well, that's great. Nothing ventured, nothing lost. We never got into the trade. But if it trades above, we're continuing in that direction of the trend. Okay? If it trades below, we're going short in continuation of the lower trend. This is all dependent on our unique Bollinger Band setting. So I'll give it to you one last time. Get your pencils and paper out. We are keeping the standard moving average, the simple moving average, at 20. That's the default. We're going to keep that the same. We're only going to be changing the deviation. The upper deviation is going to be now changed to a fraction, plus 0.382. The lower deviation is going to be changed to negative 0.382. If you have difficulty in doing that and finding that on your charting software, just contact your tech support, whatever charting software package you have, and they should help you be able to do that. This is designed to trade quick but powerful trends, as I just showed you, in multiple markets. It trades any market, any time frame, any direction. So you don't have to say, well, this doesn't work for me. It doesn't fit my style. Sure it does. So I just showed you examples in all those categories. As with all of our methods, I know your eyes are lighting up seeing how simple this is. You're probably already researching. I'm sure you're researching tons of examples on charts right now as we speak. But please, paper trade this method first. I can almost assure you that you will lose money because you won't practice it enough, okay? Most of our traders jump in far too early, so we stress and we always require that you paper trade until you fully understand the method. Our edge is consistency. What does that mean? It means that we fully realize and are aware that trades will have small losses from time to time. It's perfectly normal. That's okay. It's all about having a method that is 2 steps forward, 1 step back. As long as you're able to recoup and generate a nice upward consistency in your P&L slope, then it's fine. Don't worry about the small losses, okay? Now, as we close here, I want to ask you something, all right? And ask yourself this. Do you think this edge could have helped your trading this past year? Now, tomorrow is the 1st of March. We're heading into the 3rd month already of this new year, okay? Now, I can almost promise you that the majority of our attendees today, and we have a very large group here today, most of you probably made some type of commitment, some type of goals where you wanted to be at the end of the year. And I would venture to say that at least half of you right now are nowhere near any of those goals. In fact, you may be going in reverse. How would you like to come on board? What if you would, were able to have many more tips such as I just shared with you today, many more strategies, ways to increase your odds for consistency? Well, here's what we're sharing for all of our attendees today. Here's our special attendee discount. It's our Insights package. This is wisdom and trading strategies from the floor, okay? This is a package that we put together, and it comes with all the insights and things I've learned, many more high probability trading edges. I talk about the best ways to trade with the trend. I also give you the complete rules to 3 strategies. Now today I gave you the complete rules to only 1 strategy, 3A. Now today I give you the complete rules to strategy 1, 2, and 3. Let me show you some of those recent examples with these strategies that you get in this course here. Here's a chart of HAL. Okay, as you can see here, the stock was heading up, and then some news came out, I think, and the stock just literally fell out of bed. And I think everyone here was saying, well, we broke this support. That's a very strong support with the institutions, or maybe the volume confirmed that this is going lower. This is probably a sell. But strategy number 1, in all actuality, generated a buy signal. And look what happened to the stock after that, okay? So strategy number 1 is a great pullback strategy because it's different from what I shared with you today. Today, strategy 3A was a continuation strategy. We were continuing in the upward or downward movement. Strategy 1 is looking for some very nice, inexpensive prices on a pullback to lower levels within the overall uptrend. You can do the same thing going short. Here's another example of the strategy. Someone looking at this would say, well, obviously this is a double bottom, or we have some very nice support here, but the strategy generated a sell signal. See, all it was saying was that the overall trend is down, and this is just a snapback or a pullback to the upside. And as you can see, you had a very nice move to the downside using strategy number 1. Now, all those rules, entry, stop placement, exit, are all included in the course. We're also giving you strategy 3. Now, I gave you 3A today. I'm giving you the basic strategy 3, which is entirely different. As you can see here, on a downward move, strategy 3 generated a buy signal on the 10-minute chart of the E-mini, and look what happened, okay? The stock went straight up the next day. It can also be applied to currency pairs. This is strategy 3, entirely different from the strategy I gave you today. It's also a pullback strategy. It was going up. People were thinking the Australian dollar was going higher, but the strategy generated a sell signal, and look what happened in the following week, okay? So along with strategy number 2, all the complete rules are included in this course, okay? This is Insights, Wisdom, and Trading Strategies from the Floor. This is brand new. We're excited about this. And, you know, one of the things that I didn't talk about that's included, I go over in detail about what happened during my actual trading on the floor of the 1987 crash. As I stated earlier, I was on the trading floor trying to make markets during that crazy, crazy day. So I talk about the days following the crash and also the days leading up to the crash of what exactly was happening with the traders on the floor. So this is all tons of information, some really great, interesting stories as well included in this, as well as mentoring correspondence. So if something doesn't make sense or you don't understand or just want to ask me a question about trading, you can always correspond with me through email. All right. Now this usually goes for, this ebook goes for $99. Okay. This is sent out to you directly. It's yours. We're dropping our discount today down to not only $99, but $38. Okay. But this is for a limited time only. So I can't stress enough. There's tons of information in here, and I can almost guarantee that most of you, if you traded today, spent more than $38 in your commission costs alone. So if you really want to take advantage of this, here's how to take advantage of this sweet deal. Contact Pro Trader Strategies. They are my sister site, and they market and promote all of our courses. If you look there, you'll see their email address as well as their phone number, but the link that takes you directly to that $38 discount deal is on the bottom. Now that link is not live, but if you look in your chat box on the far right hand corner, they have posted a live link. So all you have to do is click that on the far right. You don't have to copy and paste the one on the screen, and it will automatically take you there, okay? So I'm going to leave all this information up. Remember, take advantage of this because this is only $38. I don't even think you can go out to dinner for less than $100 these days. So $38 is a great, great deal to get a lifetime full of information to help you. It's taken me 40 years to accumulate everything that's in that ebook there, and you can have it just for $38 alone. So I'm going to leave all this information up here and open up the question and answer box to see if you have any questions. And once again, thank you for holding off to the last portion of the presentation. Let's see, does this strategy work with options as well? Yes, it does, Steven. In other words, as I stated earlier, I think I mentioned it a couple of times, we are showing you very high probability entry points. All right, we're showing you high probability exit points. How you decide to trade it is up to you. If you want to actually purchase the stock, that's fine. If you want to buy an odd lot, that's fine. If you want to purchase puts or calls, that's fine. It's up to you. So we're not going to tell you how to trade that. You have to, this will only work if you only buy the stock. And that's why it works so well in all markets. So you can apply options to it. You can buy contracts with it, sell it's up to you. So it will work with anything. We're just providing you with high probability entry exit points, okay? Lionel asks, are you using only 5-minute chart for entry and the daily chart to exit? No, Lionel, everything is done off the same chart. So as you saw here, when we opened one chart, that's where all of our entry point was taken off of, where all of our exits were taken off of. We didn't change time frames at all. We only changed time frames when we looked at an entirely different chart. So if I gave you a buy setup on a daily chart, your exit is based off of the daily chart as well. It's based off of that range extension. There's no reason to change and look at different time frames. Remember, keep things very, very simple. There's no reason at all to change time frames. In fact, in my 40-year career, I used to trade that way when I first started because for some reason we've all been taught, well, that's what you should do. You enter on the smaller one and exit on the taller or the higher time frame. And, I found no consistency in using these methods. So I always suggest to my students, listen, if you want to use that technique, that's fine, but it is in no way required because as your mentor, I have found no consistency using it. I only look and trade one time frame. If I'm trading a 10-minute time frame, that's the only chart I'm looking at. If I'm trading a weekly bar, that's the only chart I'm looking at. I don't concern myself with other time frames. The signals, exits, everything is taken off the same time frame, okay, and same chart. Steve asks, he just came in, is there going to be recordings sent out? Yes, there is, Steve. Remember, all of our presentations are recorded. But remember, if you want to take advantage of this really deep discount, $38 only, you have to do so within the next, I believe, 24 or 48 hours. Then it goes back up to $99, which still is very inexpensive. But, you know, we'd love to give you a great, great discount. Okay. RP asks, can you please explain your exit strategy again? Well, I'll just go in not very much detail because it's hard to explain without charts. But remember, you're simply entering, let's say you're going long. You're entering above the short-term high, one tick above, okay? And once you enter there, you want to see where that rally started. Where was the bottom of that rally, you know, where it looked like it was going lower and then it switched and started to go up. That's your range. From where basically where you entered to where that rally started. That equals 100%. So however amount of points that is, let's say that's 5 points from where the rally started to roughly where you got into the trade. You simply double that and that will give you your exit. And you triple that and that will give you your 300% range extension exit. Remember, this is all explained in detail on the video recording, which you can request through Pro Trader Strategies. So I would say, you know, request the link. Pro Trader Strategies, the information is given there. Call them up, ask them to send you a link. But remember, if you want to take advantage of the deep $38 discount, you have to do so in the next couple of days. So don't sit on the recording and say, well, I'll wait till this weekend to watch it, and then maybe I'll decide. By that time, the price will go up to nearly $100, okay? Let's see. Augusto asks, do you use any indicator to avoid consolidation? No, actually, Gustavo, all of the, if there is any type of consolidation, that will just, the Bollinger Band setting keeps you out of it. I showed you a number of examples where you had 3 or 4 closes above and then price closed below the Bollinger Band, and then you had maybe 5 closes below, but you didn't create a short-term pivot low and then it goes right back above. That's congestion. So basically, this is just keeping you out. That's the beauty of this Bollinger Band setting. So there's no setups taking place until you have 5 closes above, until all the bars are remaining above the highest Bollinger Band, and then you create a short-term pivot high. That's telling you most likely there isn't going to be any congestion. So if you don't get a valid setup, it means that there is congestion, and guess what? You're not involved. You didn't have to take a trade. Remember, you have a choice. Would you rather be in a trade that has congestion, but at least you're trading, or would you rather be out of it altogether and not lose any money? I think over time you'd say, I'd rather be out of it altogether and not lose anything, okay? Let's see, Deanna says, my chart website only lets me change one deviation number from 2 to plus 0.382. There's no second box. Well, you know what I would say, I'm not sure what you're using. What I would say is just look to see if the Bollinger Band is smooth the way we've shown you here in this recording. And if it is, then most likely all they need is just one to calculate both of them, because they're going to be the same equidistance away from the middle moving average line. So maybe all they need is one, assuming that they're both going to be equidistant, okay? Let's see, Gasteo asks, is it a good idea to scan many time frames until you find an entry condition? Well, remember, once again, it's up to you. I would suggest first determining what type of trader you are. Are you a short-term trader? Do you like to trade intraday bars, okay? Or are you a swing trader? Do you like to hold positions overnight? You have to narrow it down to fit your needs, because as I said in the beginning, it goes against our philosophy to tell you how to trade. I'm not going to sit there and say, yes, this is what you should do, and you must scan every night and do this. Then I'm basically taking you out of the picture, and that will lead you to become an unsuccessful trader, in my opinion. I don't want to do that. I want to make all of our students successful traders because there's enough for everyone to go around. So I'm giving you ideas and suggestions. How you want to find these trades is up to you. But I would first start out small just so that you don't overcomplicate things. So in order to start out small, you have to decide, well, what type of trader am I? And that will narrow what you're looking at. So you won't, if you know you're a short-term trader, well then obviously you're not going to be looking at daily bars or weekly bars. So that automatically has been eliminated. And you can just focus on small intraday trading. Now weeklies, sure, I showed you examples with weeklies. I think I did, but if I didn't, it works just as well with weeklies. You can apply. My only suggestion is, remember, if you're using weeklies, the higher time frame out you go, you will get less signals, because just of the nature of the way time and space works. You know, the bars take much longer to complete. You know, you have to wait an entire week for a bar to be completed. So obviously it's going to stand to reason you're going to have to wait longer, and you're going to get less signals because you're waiting longer. Whereas if you're only waiting every 5 minutes for a bar to happen, you get a lot more opportunity. But with higher time frames, you'll also have higher risk because the bars are spread out more, and you'll have higher opportunities for profit. So it's all up to you. You know, a lot of our members like to use this on weekly bars, but they apply options to it. That's fine. There's no one right or wrong way to trade it. The only wrong way to trade it is when you, as a trader, take all of your decision process from someone or something else. That's the wrong way, in my opinion, regardless of what strategy you're trading, if it's one of mine or someone else's. And the reason is because you're taking yourself out of the game. I ask you this honestly. Find out, how do you make your decisions every day? Do you go to a signal service? Do you wait to see what somebody says in a chat room? Are you listening to what everyone's saying on TV or waiting for the news to come out? If you are, you're taking yourself out of the game. It's like someone flying an airline and the pilot saying, well, what do I do now? What do you think? What do you think I should do? You know, would you want your pilot to be saying that? Well, it's the same way with trading. Would you want to be asking yourself those questions? It's your money. Why are you relying on someone or something else to tell you how to use it? So we're providing you with all these things that have stood the test of time, these methods, providing you the information. We're counseling you. I'm your personal mentor in these courses. And then we're, nurturing you along the way. But ultimately, our goal is to have you be totally in charge so that you don't have to rely on us at all. Okay? Yes, yes, George, it's extremely important to be self-determined. And I'm saying this, I hope you don't think you attendees out there are saying this because I'm coming from this, very, authoritative point of view, or, being arrogant or condescending. I'm saying this actually from firsthand experience, because when I first started trading, that's the way I traded. For some reason, we're all taught to trade the same way, conventional wisdom. Let's look at support and resistance. Let's look at volume. Let's listen to the earnings reports. Let's look and see what all the institutions are doing, and I did that. I looked at Fibonacci and all that stuff. And my first year or so in trading, I couldn't make a dime. In fact, I didn't think I was going to be trading much longer because I thought I was going to be fired. But I was lucky enough to have some mentors. These were specialists themselves on the floor who've been trading about 40 years each. And they saw how much I was struggling. And the very same thing I teach to all my students is what they taught me. They told me to release all this useless information, what they called noise, and to just focus on learning how to listen to the market. And I said, I don't know how to listen to the market. I've never been taught that. And they taught me what they had learned from their mentors. And I think that information is really what sustained me going on 4 decades now. So this is all we try to do at Specialist Trading, give you the same things so that hopefully you can, be trading not just 5, 10 years, but 20, 30, 40 years down the road. Okay, in closing now, once again, here's the information. Contact Pro Trader Strategies if you want to get that link to that for our recording for today. But remember, if you want to take advantage of that great deal for our ebook, you must do that within the next, I believe, 48 hours, or else the price goes up about another $60 or so, $70. So take advantage of that to get that very inexpensive $38 discount. The link is on the right. It's a live link. All you have to do is click that on. It will automatically take you there, okay? In conclusion, I just want to say thank you so much for attending. I hope you got something out of this. You have a free strategy, but please paper trade it first so you fully understand it. Thank you so much for attending today. I wish you the best of luck in trading, and I look forward to all of you becoming students of mine at Specialist Trading. Thank you so much. I'll see you next time. Bye-bye.